Given the current situation in Europe, we wanted to give clients some additional insight into our game plan this week and the rationale behind that game plan. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Before we get started, I just want to emphasize that this video is for CCM clients, and all of the disclaimers at the end of the video apply. Where are we as of the close on Friday, June 26th? We're presently 1.36% off of this recent high, and we'll use that as a reference point relative to the question, it's too late to manage risk. The fact that in 2015 we're 1.36 or 1.35% off of a recent high, that tells us something about the market's current risk-reward profile. To put some context around it historically, 1987, if we were in a similar spot, 1.35% off of the most recent highest closing high. In terms of managing risk, the 1987 event didn't end, we didn't hit a closing low until 99 calendar days later. So in this instance, there was plenty of time to incrementally reduce risk relative to where we are now in 2015. How about a bear market? Is there typically time to reduce risk after bad things start to happen? March 23rd, 2000 is the peak in stocks. The bad things happening cycle did not end until 930 calendar days later when we hit a low on October 9th, 2002. Therefore, if we were 1.3% below the recent high, which is similar to where we are today, there was more than ample time to make incremental adjustments in terms of reducing risk and missing some of this pain. How about the 2010 flash crash period? Admittedly, one of the more difficult periods to manage risk. If we were in a similar spot to where we are today, we were 1.3% off of the recent closing high on April 27th, 2010. The flash crash incident and low didn't come until 66 calendar days later, on July 2nd, 2010. Anything can happen in the markets, and we're showing historical cases because they speak only to probabilities. How about when Europe was a problem? If we were in a similar spot in 2011, in 2015, we're 1.3% roughly off of the recent closing high. That occurred here on May 4th, 2011. The stock market and Europe-induced fear event didn't end until 153 calendar days later. It was almost 6 months from the period that would be similar to where we are today to the intraday low and reversal that was made on October 4th, 2011. Now that we have some idea that the market, at least in the short run, is leaning in a negative manner, we can revisit this chart and talk a little bit about general strategy. We're not going to get too specific here, but clients will be able to understand it relative to what we own today. This is the close here on Friday, June 26th. These are the trend channels that we've explained numerous times. The only line that we've added is now what appears to be a short-term lower high, really not that much different than this period here or even here. This is a channel, intersects in this area here. The net bottom line is the same as it's always been. You wouldn't expect us to change our approach because the chart has not changed. We're just putting some more context around this. Bottom line is this: as long as we stay above 2039, we prefer to cut risk at a slower rate. These levels here tell you, relative to the close on Friday, June 26th, from this level here, if we drop to 2076, that's a 1.19% drop from Friday's close. If we go to 2064 from Friday's close, it's 1.76%. And if we drop all the way down to 2034, or below this number here, it's still only a 3.19% drop. Try to remain patient in here. Why? Because we're still in an upward sloping trend channel and price really hasn't proven to us yet that we're experiencing a bearish trend change. We may, and the plan calls for, cutting risk potentially based on what happens next week at a slower rate if these levels are taken out. So in theory, if we close below 2076, we might make a relatively small cut. Why? Risk is undoubtedly increasing, and the market model requires, by rule, that we begin to reduce risk if the market doesn't bounce back. Slower cut, slower cut, slower cut. Below this level here, 2039, that we've been talking about literally now for weeks, maybe months, it's still relevant. So let's say we close below 2034, which is the December Fibonacci retracement level, and we would be below this level here. Once this level is breached, we would start to move away at a faster rate. What we're doing is we're saying we're willing to see what happens between here and a 3.19% drop to see if we hold in this area. Why? We could get a fairly significant bounce and we could recoup these losses relatively quickly. If we close below 2034, hypothetically, why might we want to reduce risk at a much faster rate? Now the odds of a correction lasting several weeks or several months are much, much higher if we close below this level. We would cut risk at a faster rate because even if we were patient and saw 3.19% drop from here to here, we could see an additional 5.61% from this level here to this level here. 1919 would represent the median bull market correction since 1982. This is roughly a 9.9% drop. The average bull market correction since 1982 is quite a bit larger than that, and it would take us all the way down to 1819 based upon the average percent drop in the correction relative to this recent closing high. We will cut risk faster here because we don't want to experience an additional 5.61% or an additional 10.57%. There are over 53 levels that we'll be watching. These levels are just used to summarize the bigger picture and our approach for next week. We also have to understand when we get into this area here, there are other levels that are significant. 2014 is a Fibonacci retracement level. We don't know when the market will reverse. It could happen at any time, at any level, if the inputs change. If the situation in Greece is somehow improved or there's some type of resolution, the market could bounce back from any level, meaning we always have to maintain maximum flexibility. Net bottom line, cut risk at a slower rate as long as we hold these levels here. Below this level here, we cut risk at a much faster rate because we could drop all the way down to 1919 in a median correction based on history, or all the way down to 1819 based upon the average bull market correction in this recent high. If you haven't seen it, there'll be a link on Short Takes to our Twitter feed, and you can find this chart and click on it and read this text here, or you can just pause it and read this text. The purpose of this and some of the other tweets that support this, if you look at our Twitter feed, and you don't have to know anything about Twitter, you don't have to be a Twitter user, or you don't have to particularly like Twitter to click on the link and read it. It's just like any other web page. You can click on images to make them larger. Point here is, for these reasons, we should keep an open mind about all outcomes. It's very, very easy to understand the bearish case. It's a little bit harder to understand the how could stocks potentially surprise on the upside this week, and that might include losing less than we might expect. For these reasons here and additional reasons, the present day market as of the close on Friday, June 26th, was quite a bit more resilient and positive than the market was here at this highly vulnerable point in 2011. Again, you can read this and see the supporting tweets on Twitter. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.